What if I told you the thing that controls your mortgage rate, your job security, your car loan, and even the value of your currency isn't the president? No, not Wall Street, and not the stock market. It's a system that nobody understands, but it decides everything. Today, I'm going to show you the hidden machine your entire life runs on. We'll focus on government bonds, as they're the backbone of the system. Here's the part that most people really never get: the bond's price and its yield move in opposite directions. Here's an example. Yesterday, the government issued a 10-year bond at 4.5%. Today, new bonds only pay 4.1%. Which one would you want? Obviously, the old one paying 4.5%. Because everybody wants it, the price of the old bond goes up until its price rises high enough so that its yield to maturity is only 4.1%. This is why yields fall, bond prices rise. Yields rise, bond prices fall. This single rule controls everything else in the economy. The 10-year yields fell to 4.11%. So what? Here's the connection. Your mortgage is a long duration cash flow stream, which, when packaged and sold, becomes a bond like instrument. When you take out a home loan, the bank doesn't keep it forever. They sell it to institutions like Fannie Mae, Freddie Mac, government sponsored entities, or GSEs, or they sell it directly on Wall Street. Wall Street bundles thousands of mortgages into mortgage backed securities, and investors buy them the same way they buy bonds. These mortgage backed securities compete with treasury bonds. Investors think, I'll only buy these mortgages if they pay at least 2% more than the 10-year treasury bond. So if the 10-year drops to 4.1%, then mortgage rates get pulled down towards 6.1%. Here's an example. Earlier this year, the 10-year was 4.5%, and 30-year mortgages were roughly 7%. Now the 10-year is closer to 4.11%, and average mortgages are around 6.1 to 6.3%. That's literally hundreds per month saved for borrowers. You're not getting a nice deal because banks like you. This is just the bond market pulling the strings. Here's the paradox that confuses almost everyone. If falling yields make bonds more valuable, why does money flow into stocks, real estate, crypto, and everything? Because the bond market acts like the menu price of the safe return. Think of the 10-year treasury yield as the basic burger and fries combo on the investment menu. But here's the key. This isn't about the price of the burger. It's about the value of what you get. When the 10-year treasury pays 4.5%, that burger gives you a solid amount of food for the price. A nice, safe, predictable return. Upgrading to a stock that yields 6 to 7%, a corporate bond at 6%, doesn't feel very compelling. The safe burger is already a great deal. When the 10-year treasury drops to 4.1%, the burger suddenly gets smaller. Same risk-free asset, but now it gives you less return, and instantly, the steak, the salmon, and the chicken sandwich all look way more attractive for their price. Nothing about the steak changed. Nothing about the salmon changed. What changed was the value of the safe option. Lower yields equals lower price of safe money. So when treasuries fall, the safe return becomes less rewarding. The discount rate used to value future cash flows drops. And suddenly, almost every risk asset looks cheaper on paper. That triggers capital to flow into stocks, real estate, corporate bonds, private credit, crypto, startups. Not because people are fleeing bonds, but because the opportunity cost of holding the risk-free asset has decreased. That's why a tiny drop in yields can unleash trillions into global markets almost overnight. by increasing the present value of all future risk asset cash flows, instantly boosting valuations across global markets. Let's jump into the opposite case, Japan. This is the bond market's horror movie in real time. Japan's 10-year yield jumped from 1 to 1.95%, reaching its highest level since 2007. Why? Because the Japanese government just approved a 21.3 trillion stimulus package. That's about 137 billion US dollars at the time of this recording. Imagine dropping the entire GDP of a small country into an economy at once. Japanese game show, right? To fund this, the government must issue more bonds. Even if some of it's covered by tax revenues, markets still see more debt supply, more fiscal risk, more pressure on future inflation and yields. More bonds equals more supply. More supply equals investors demand higher yields to hold them. Meaning investors demand higher yields to hold Japanese government bonds, and that pushes bond prices down and yields up. Bond prices fall, yields rise, and that's where the real pain begins. Let's zoom into a real Tokyo business. Forget the macro for a second. Picture a mid-sized Tokyo manufacturer. They borrowed 100 million yen, about 650,000 USD at today's rates. Their loan is variable rate, tied to short-term interest rates. In Japan, that's normal. Most new mortgages and many business loans are variable rate. For years, Japan's policy rate was near 0%. So they were paying something like 0.5 interest. At 0.5, their annual interest cost is 0.5% of 100 million yen is equal to 500,000 a year. That's around 3,300 a year and $275 a month. Annoying? Sure. Crippling? Nah. Now imagine the Bank of Japan hikes rates to defend the collapsing yen, and that rate jumps to 2%. Same loan, same business, but now 2% of 100 million yen is 2 million yen a year. That's about $13,000 a year, over $1,000 a month. Their interest cost just quintupled. Nothing else about their business changed. Same customers, same products, same employees, but now a huge chunk of their cash flow gets eaten by a debt service. So what do? Delay hiring, freeze salaries, cut investment, push prices up, or in the worst case, people get laid off. Multiply that by thousands of similar businesses across Japan, and suddenly a simple move in bond yields becomes slower growth, weaker job market, more cautious banks, more pressure on the government to do something, which often means more stimulus, more bonds. Why the Bank of Japan is stuck? Here's the trap. Japan has enormous government debt, over 250% of GDP, and the Bank of Japan now owns roughly half of all government bonds outstanding. A huge amount has to be rolled over every year, and the Bank of Japan holds almost half of it and pays interest on the reserves it creates. That means a big slice of the government's own borrowing costs behaves just like that Tokyo business. So, as yields rise, government interest bill marches higher as old bonds mature. The Bank of Japan's interest expense on reserves go up. Households and firms with variable rate loans feel rate hikes immediately. This is why the Bank of Japan is faced with a brutal choice. Option 1, hike rates hard to defend the yen and fight inflation. Yen strengthens, but government interest costs rise over time. Households and businesses with floating rate debt get squeezed. Or option 2, keep rates low. This protects the government borrowers, but the yen stays weak. Imports get expensive. Japan imports inflation and investors start doubting its bonds. Right now, Japan is trying to walk this impossible tightrope. Yields are rising. The yen is under pressure. Businesses with floating rate loans are feeling the squeeze. And the government just added another 21 trillion stimulus on top. This is what a bond market trap looks like in real life. It's not just lines on a chart. It's a factory owner in Tokyo staring at a loan statement and realizing, if rates go up again, I can't afford this. And before you think this is just a Japan problem, here's the uncomfortable truth. The United States is slowly drifting towards its own version of this setup. The US now rolls over trillions of dollars in debt service every year, at whatever yield the market demands. If yields spike like they just did in Japan, you'd see businesses cutting hiring, government interest costs ballooning, households feeling it through new mortgages, car loans, and business credit. Japan is not an outlier. It's a preview of what happens when a country leans too hard on cheap borrowing and the bond market changes its mind. Now, let's flip to almost the opposite case, Switzerland. Swiss 10-year government bond yields around 0.16%, close to zero. Why? Three big reasons. Small, highly rated government debt. Safe haven status. Global investors love Swiss assets in times of stress. A central bank that has kept policy rates very low and intervened heavily in foreign exchange markets. Let's look at some numbers. Market traded Swiss federal debt is only on the order of 80 billion. The Swiss national banks historically bought foreign currency assets to prevent the franc from appreciating too quickly. And yes, those assets included large amounts of foreign stocks and bonds, not just domestic. So Switzerland isn't an example of the central bank owning almost all the government bonds. Instead, it's a country where debt is small, investors line up to hold it, and the central bank has used QE mainly by buying foreign assets. The effect is similar for yields though. Strong demand, limited supply, bond prices stay high, yields stay low. How does this shape everyday life? Households benefit from low yields because yields are near zero. Mortgages rates are lower than in most countries. Business loans are cheaper. Government debt is easy to finance. That supports lower borrowing costs, a generally stable fiscal position. Secondly, the Swiss franc stays strong. A strong currency means imports like energy, food, electronics, cars often cost less. Imported inflation stays low. Swiss households feel this at the store and at the gas pump. Exporters feel the squeeze. The downside of a strong franc? Swiss goods become more expensive abroad. Exporters, think precision machinery, watches, pharmaceuticals, have to work harder on pricing and productivity in order to stay competitive. Good consumers, not always great for companies selling abroad. And the government likes low yields, with a nuance. Low yields mean the government can finance itself cheaply. Interest costs stay small relative to tax revenues. This is because the government issues relatively little debt. Investors trust Swiss credit. The S&B's broader policy mix, low policy rate, foreign exchange interventions, safe haven inflows, keep yields anchored. Japan struggles because rising yields choke the economy. Switzerland thrives because near zero yields, a strong currency, and modest public debt. Here's the missing link most people never learn. Bonds, banks, central banks, and money creation are tightly connected. In modern economies, most broad money is created when banks make loans. Government deficits add net financial assets to the private sector, often financed by issuing bonds. The central banks can create base money, reserves, and cash when they buy bonds, QE. Here's a simple chain. Government issues a bond to finance spending. Bank or investors buy it using existing money, or the central bank buys it, creating new reserves. Government spending puts that money into the economy, paying workers, contractors, transfers. 4. If that money flows abroad or gets sold for another currency, the exchange rate moves. Bond yields and currency values constantly react to these flows. Japan example. Governments issue Japanese government bonds. Banks and the BOJ buy them. BOJ's QE creates new yen reserves. Global investors and carry traders may borrow yen, sell it, and buy the dollar or other currencies. That selling pressure can weaken the yen, making imports more expensive and importing inflation. The US example. Treasury issues bonds. The world buys them. Foreign central banks, funds, and institutions. To buy treasuries, foreigners need dollars. That demand can support a stronger dollar. A stronger dollar leads to cheaper imports, reduced imported inflation. Lower inflation expectations over time help pull yields down. Lower yields, higher bond prices. Risk assets, stocks, crypto often rally. The Switzerland example. The Swiss government issues relatively few bonds. Demand is strong because Switzerland is seen as ultra safe. The SNB prints francs mainly to buy foreign assets, trying to weaken the franc. But safe haven flows and a small bond market still keep the franc strong and yields low. The big picture: bonds, money, and currencies form a feedback loop. This isn't just macro theory. You're living inside this machine right now. Here's what falling US yields have already done. Mortgage rates dropped from the high 7% range towards the low 6% range. Car loans will follow. Credit cards and personal loans slowly adjust. Bond portfolios gain value as yields fall and prices rise. Stocks and crypto pump on lower discount rates. And here's the Japan warning. If the US keeps piling on debt, pushes more short-term refinancing, and leans heavily on stimulus in every downturn, the dollar could weaken in the 2030s, the same way the yen is collapsing today. This is why big institutions, Norway's oil fund, Saudi Arabia's PIF, and even JP Morgan have been talking about owning more real assets and being careful with long-duration government bonds. More hard assets, gold, commodities, quality real estate, strong cash flow businesses, and, for some, crypto as a debasement hedge, because they know what happens when the bond market flips. Here's the entire financial universe in 1 minute. Bonds set yields. Yields set borrowing costs. Borrowing costs shape growth, jobs, and housing. Bond demand affects currencies. Currencies influence trade and inflation. Central banks heavily influence the bond market. And everything eventually circles back to yields. Once you see the bond market, you can't unsee it. It shapes your mortgage. It shapes your currency. It shapes your job market. It shapes your investments. It can stabilize or destabilize entire nations. And now, you understand the system quietly running the world better than 99% of the people on the planet. If this helped you see the world more clearly, support the channel, like, share, subscribe, and tell us what you want broken down next. This has been your host, Bobby from Virtual Samosa. Thanks for watching.